Ray Kennedy, high yield or junk bonds have made somewhat of a comeback since mid-February along with the equity market. So where are valuations now, and was that the bottom, you think?
I don't know if it was the bottom, but we definitely are approaching a valuation point that I think will have a sustainable value attractiveness for investors. We clearly were approaching this 1,000 mark, which is the number we kind of use as the golden number that says you're at recession type levels. We were within 10% of it. What's going to basically continue to weigh on this market is this tension. Are we in a recession or are we in a massive air pocket? None of us really know at this point. What I will say is for the long-term investor, I think it's getting pretty attractive. And I've encouraged investors, if you have $100, maybe you're supposed to put 25 in now, because you're never going to find the bottom. But we're clearly a lot more attractive than we were a few years ago. We know that.
Well, the big worry right now is whether or not the problems in the energy sector are going to infiltrate the rest of the high-yield world. What's your view? Is energy cordoned off enough to protect the rest of high yield?
First of all, it already has. If you look at kind of the earnings that we've been watching for about the last 12 months, once this all started, we watched company after company have exposure that I think quite surprised a lot of us. Sometimes it was 5% of their earnings, sometimes it was 8% of their earnings. So we've kind of weathered that. In fact, I would say we've kind of gone through the worst part of that. Now, we will continue to see some defaults. We have 50% of the names in energy are trading below $50 price. So in essence, the market has already expected this to occur. What I've been telling investors is that, look, you can find pockets in this space. There are going to be headline defaults. There could be a Chesapeake default. We don't know. But if you're focused on the default statistic, that's the wrong thing. You need to focus on the valuation. And now we've got high yield energy bonds yielding 1,500 basis points, which is a pretty astronomical level. You can find value. I mean, at Hotchkis and Wiley, we've tended to focus on balance sheets that tend to have low borrowing bases ahead of us, so we're more senior in the capital structure. We tend to focus on companies that have concentrated areas, so they're not spread out. That's one of the mistakes you'll find with a lot of the big issuers in high yield. So there are pockets of valuation that you can basically look at. There are certain names that are attractive. Investors should not get wrapped into the actual default stats.
All right, what about the metals and mining sector? We've seen a comeback in gold. I'm not sure why, and perhaps it's for geopolitical fear reasons. That said, will that spur the high yield bonds to come along?
No, that's the one area I do tell investors don't get excited about. Coal, there's nothing good that's happening in the coal space. Let's face it, even with a new administration, it's going to be a challenging regulatory environment. The steel sector, which is another part of the metals and mining space in high yield, that's under a lot of pressure. You can't see that changing anytime soon. The demand profile is bad. I mean, there are 250 steel plants in China. You can't compete against that. There are certain areas where there seems to be some growing demand, like aluminum. There are certain areas like the processors. The core miners that we have in high yield, something like a Molycorp, et cetera, they will continue to struggle on their cost curves in a competitive world. So I don't see much attractiveness there. There are some investment grade names to keep an eye out for. For example, Tech Resources would be one that we tell investors we're going to keep an eye on. That could be attractive. Obviously, we have Freeport. That's the big guy out there that we're all watching.
What about liquidity? We know that Third Avenue had problems with its fund. That was more of a distressed fund than a high yield fund. But that said, we've seen a lot of investment banks, Wall Street brokerage houses, lay off a lot of their bond desks. So what's going on with regard to liquidity? Can you sell paper when you want to sell paper?
We can because of our size. We're lucky. I think I would look at some of these big funds and I realize they're probably liquidity challenged. Trying to move 25 or 50 million in one clip is very difficult. The way I look at liquidity is that investors just have to get paid for it. And that, I think we can all agree, is starting to happen. In the old days, we used to say that the liquidity premium was somewhere between 100 and 200 basis points. That's probably widened out to 200 to 400 basis points. So in some sense, I would say it's actually becoming a little bit more attractive. Now, can you transact in this world? You can. We're back to a little bit of the old agency model that we had in the mid-1990s. When I joined this business, our largest counterparty was actually an agency firm. It was never a big Wall Street firm. So we're kind of going back to that model as the street shrinks their business model, which was largely driven by new issues. It doesn't mean it's going to disappear. It just means it's going to shift a bit, and it'll take some time.
All right. Well, thanks a lot, Ray.
Great. Thank you. All right.
Thank you for watching The Street.